This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. What is up, Zinger Nation? Welcome back to Benzinga Live. And we're back. We're back like we never even left. The market is basically back at all-time highs. Of course, the Dow yesterday hit its all-time high above 37,000 for the first time. I'm going to go ahead and pull up my Benzinga Pro. We're going to check, just see how the indices are doing right now. Last I checked, SPY was still trading slightly higher up today. Another about 0.3.5%. 0.35%. So here, let me go ahead and pull this up real quick. Tech not having the best day. Microsoft kind of lagging day. So we're going to talk about all this. We're going to talk about how to play this rally. I'm going to bring on my man Steve Kalyjian here in a minute. Let me go ahead and share my screen real quick so we can get these charts up. But I mean, yeah, you guys, yesterday was just one of those days where if you weren't in the market, if you weren't, long, if you were either short or if you were all cash, you missed out on this and you were like, what the hell is going on? And I've been kind of talking for the past, 6 months about how I don't really understand, I guess, the bear case right now. I mean, now that we're up here, look, am I going to say that I think, the market's going to just go straight up from here into 2024 for the next few months? No, probably not. Of course not. We're going to have probably some healthy pullbacks, probably, stall out a little bit here or there. But for right now, all things considered, right? And I know there are reasons out there to maybe think, okay, maybe this isn't, the best market conditions of all time. But all things considered, inflation's a lot lower than it was a year ago. Unemployment's lower than it was a year ago. Economic numbers in terms of GDP, productivity look pretty good. And you have a Federal Reserve that's now talking about cutting rates. So I don't know why, with all these things considered, someone would still be more bearish than they are bullish right now. Now, with that said, we had Jerome Powell speaking yesterday, and he said, we haven't seen the full effects of where interest rates are at yet. It takes a while for that to kind of reverberate throughout the economy. Rates above 5%, obviously the highest they've been in the last 20 years. And recently, we have seen a number of companies kind of start to increase layoffs again. I mean, just in the last week, we got huge news from Hasbro that it was laying off more than 1,200 employees. Spotify laying off more than 1,000 employees. So I think it's very plausible that over the next few months, we're going to see more of these layoffs and we're going to see maybe that unemployment number trickle higher, which is why I think Powell and they are, are probably seeing this data a little bit ahead of us and looking at these things that, okay, in real time, we're seeing more of these layoffs. I think that's why, they're talking about, maybe cutting is because some of these effects we just haven't seen yet. So again, when we start seeing that, there'll probably be a lot more people that are like, see, the market's not as great. The economy is not as great. But again, if that is all that's happening, but then we're going to get rate cuts on the other side of it, then I don't know really what that means for the market in terms of would we see another big 5 to 10% crash? I mean, regional banks, this was the biggest kind of question mark, at least to me, throughout the last 6 months. And are we going to see more pain? Are we going to see more banks like Silicon Valley Bank collapse? Are we going to see this interest rate kind of create more havoc in this space? And as you can see here, the market since about late October, the last month and a half, the last 6 weeks, does not seem real worried about the regional bank sector at all. The KRE, this ETF that tracks the regional banks, is up now from $37 to $54. A 35% increase in the last 6 weeks. So that was, again, the biggest question mark to me. And it looks like the market's saying, hey, we're not as worried about this anymore as we were. And I think the lower interest rates, ends up helping a lot of these smaller banks and especially the ones that are holding a lot of these treasuries that were losing value as interest rates rose, because now if they come down a little bit, those treasuries start to gain in value. But all right, let's go ahead and get my man Steve Kalyjian on, because I'm curious what he's been trading, what his outlook is. I mean, again, this is kind of some crazy time, so I want to bring in some other people, bring in some other viewpoints. So without further ado, let's go ahead and bring my man Steve K on the show. All right, Mr. Steve Kalyjian, how you doing on this Thursday?
Hey, brother, how are you? Happy holidays, Merry Christmas, everybody. Thank you.
Yeah, happy holidays, Merry Christmas. I mean, I'm good, man. Santa came early, brought us new all-time highs in the Dow yesterday. Stocks are looking great. A lot of my small caps that I've been buying up are soaring. What are you trading? What's your outlook right now?
Well, my outlook, I actually wrote a report this morning that I would be more, I think this, even if we get new highs in the spiders and the Qs and we make new highs on the S&P, I think this is a rally you have to, in my personal opinion, you have to sell your portfolio into. I think there's a lot of risk in 2024 here. There are several gaps, several gaps below the market down to when we hit that low of 41.22 on the S&Ps. So I am more, I think there's, they say you can never time the market. Well, that's what I do, right? We had the lows back in September, right? On those lows there, I was calling for a rally. Then I had more confirmation when I got a signal on my various different time frames. And when the weeklies reversed to buy on the S&Ps of 45.01, I just thought we were going to push up here. My target was 47.80 on the S&Ps, and we're right around there now. Not to say we can't go higher, but then close, the year, somewhere in the 47.40, 47.80 range. And if we do take new highs, this is a euphoric. The bullish sentiment right now is at a 48. The average is 37. I have one of the most overbought conditions on the weeklies and on the dailies. I have several gaps below the market. I say let them have them. And you know what? You can always buy them again at a lot lower prices. I remember the same scenario happening. I don't give investment advice, but I talk to people who are friends of mine. They say, what do you think? And I said, when the S&Ps were at that 4808 level, 4800, I said, if you're long anything, I would be selling my entire portfolio up here. And we went down to 3600. Okay. So, and the complacency level here is at an historic high, right? And so I'm going to be 41 years in the industry. You know what? Guess what? You don't know what's going to happen, and it just always comes out of left field, right? COVID happened, this happened, that happened. Something always happens to cause a vacuum down. Me, if I was long in a portfolio, a basket of stocks, and I was in my 50s, 60s, 70s, or even 80s, I say let them have them. Then if I don't care if they go to 4,900, 4,850, the risk to the downside, in my opinion, is greater than whatever 100 points up on the upside on the S&Ps going forward.
Yeah, and I could get behind that sentiment, I guess, just in the sense that right now, if you're playing the upside, there's probably, a point where the market's going to run out of steam at some point here in the near future, where, again, I'm not saying that means the market's going to come crashing down from there, but it might have a slight healthy pullback, or it might just kind of stagnate to where if you were playing the long side, maybe your returns would be somewhat limited right now.
Yeah, but right. So why not lock in your returns, which is a phenomenal year on the NASDAQ, a great year on the S&P, right? The Dow just made all-time highs. Me, I say you lay into them. My personal opinion, you let them have them. You can always buy them back again. There's gaps on the 4170 on the S&P. That's, you're talking, 700 points from here, 600 points from here. That's times 9. That's 5,000 points on the Dow, right? And that could easily happen. I've been doing this, like I said, August 1st of 2024 will be 41 years. I've seen everything, so I would not want to own them up here at all, in my personal opinion. I don't care if there's another 50 or 80 handles on the S&P on the upside. I say you sell into it.
So why do you think, it seemed like yesterday, at least my perception of what I was seeing on Twitter and around, was there were a lot of people that were it seemed upset with the market going up or the Fed's decision. Why do you think people
Because
are?
I think, because again, so in 2016, I was on another show, and it was around 6 o'clock. I never forget this as long as I live. And the commentator, very well-known commentator, I know very, very well. I had 3 minutes before the show went live, and I met someone back in the green room, and we became very buddy and chummy. And then during the time I was sitting there for the red light to go live, the person asked me, this person that was sitting to her right says that we're going to have a recession in 2016. And I said, they'll never let it happen. She said, who won't let it happen? I said, the Federal Reserve will never let a recession happen during an election year, right? Next year, 2024, is a presidential election, okay? And I believe this was politically motivated. I think that the comments that were made today were hyped up for a political reason. Now, I don't see any capacity to believe the Federal Reserve. They mandated 2% inflation, 2% inflation. They didn't want to hear the data at 3, 4, 5, 6, 7, 8, 9, 9% CPIs when they started jumping in like a Comanche, right? They don't know what they're doing, in my personal opinion. And I think yesterday, why people are upset is because I believe there should be no Federal Reserve, in my opinion. I think the natural bond market told you the story when the 30-year bonds hit that 107 level and change, and the 10-year was nearing the 5%. And I said, this has got to be a bottom here. I don't care if they go to 5.5%. I don't see them based upon that. Now, the bond market is now up 15 full points on the 30-year bonds from 107 to 123 right now. The natural bond market is the real gauge of the market of interest rates. The Federal Reserve is just a talking point. Every single day in the last 2 months, there's got to be anywhere between 1 to 5 Federal Reserve people talking every single day. There should be, in my personal opinion, there should be no talking, no nonsense. And if you want to talk, it's before or after the market. I think why people are upset is because I think it was politically motivated yesterday. And I think that is what fueled the market.
Yeah, I mean, I guess I understand that sentiment, especially if you were on one side of the political spectrum. But I don't personally believe that to be true, especially considering, I mean, the fact that, I mean, Powell was brought to became the FOMC chairman by President Trump. Like, it's not like he's even a Biden nominee.
Well, yeah, no, I'm not. I'm just saying. I think that.
No, I agree. I think that's why a lot of people were. And I think maybe, too, you have people out there that just assume, okay, Biden's in office, that must mean the market's not good or the economy is not good. So when there's data or when the market goes to new highs, it goes against that. And those people aren't, I guess, happy with it. But to me, it was like, I've seen people upset that stocks are going up, that Americans' 401ks were looking nicer, that all these things. And it's like, I just don't understand, I guess, the reaction to be upset by it, unless, of course, you were short and you missed out on it, or you were all cash and you missed out on it. But again, that's you. Yeah, that's your choice in not investing in these American companies. And I mean, Warren Buffett's like whole rule is, I'm never going to bet against the U.S. economy because it just doesn't stop. It doesn't matter who's in office, if it's a Democrat, Republican, whatever. Like I don't care about any of that. I'm just looking at the market, and I don't think Powell is thinking, here's 2024 coming up. Let's make the market look real good for Biden, considering he's not even a Biden nominee. He was a Trump nominee and was with and originally nominated in the 90s by George H.W. Bush. Like, it's not like he was a lifelong.
But there was no reason to come out and say, in my personal opinion, that they're looking at 3 rate cuts next year, when the CPI number is still above their 2% target range. And I got to just tell you, I mean, they exclude food and energy. Yes, energy has come down quite a bit on oil, right? Down about $28 off the high, right? But you still have high rental properties. Food costs are very expensive. What was it? 63% of the households in the United States live paycheck to paycheck. So I think that there is still a staggering amount, of people who cannot handle the everyday living capacities based upon costs. So this, to me, to come out and say, well, 3 rate cuts for next year, what that means you're seeing a slowdown to some capacity.
Yeah, and that's part of why oil's off so much is because there's demand concerns. So I think the Fed's looking at that, and that's why they're saying that. I don't think it has anything to do with politics. I think it has to do with the economics of them
More
saying.
people have electric cars now as well.
Well, not enough. Yeah, I mean, that might be but I think more so when they're talking about the cuts, it's because Powell and the Federal Reserve is starting to see maybe an increase in unemployment or layoffs and a weakening demand for oil globally. So
unemployment's still strong. You have 8 million people out of work with 11 million jobs. Right
now. But I think, and if you listen to Powell, what he was saying yesterday was we haven't seen the full effects of high rates yet. So over the next few months, you might start to see that unemployment thing go up. And that's why I think they're talking about cutting rates. Look, if for the next 3 months, unemployment keeps dropping and inflation shows signs of picking back up, I don't think the Fed's going to say, yeah, we're going to stick to our plot and cut. They're going to say, no, let's keep rates where they're at. Obviously, this is neutral if unemployment. But again, I think they're saying that because they're starting to see some sort of a slowdown happening, which is why they're even talking about it in the first place.
But the thing is, I've been in this game, like I said, the highest I ever saw back in the days when the Dow hit 10,000, the Fed funds rate were about 4.5, 4.625. Now we went above that for the first time in 22 years in the last several months. If you have a stock market making new highs here on the Dow, why not keep the Fed funds rates high if the markets can absorb it and the economy can absorb it? The only way you would want to cut interest rates is if you're fearful of an economic slowdown, soft or hard recession, and or if you see the labor market really, really starting to jump significantly higher. And I don't see any of that right now.
Right. I think, and I think their thinking is that they are going to see some sort of the A scenario that you laid out, that there is a slow or a soft slowdown happening in the first quarter of 2024. And that's why there might need to be rate cuts. And again, if that's not the case and there is no slowdown, then I agree that they shouldn't cut rates. But again, from what I could understand from listening to Powell speaking yesterday, that was kind of the backdrop against it. It wasn't like he was saying, hey, everything's dandy, inflation's gone, we're going to cut rates. Boom. He was basically saying, hey, things might start to get a little bit more rocky out there. And so we're predicting that we're going to end up having to cut rates a little bit. And again,
everybody was anticipating potentially a 2 rate cut. The reason why the market rallied because he said a 3rd cut.
Okay. And so, yeah, again, I mean, I don't think, they should be mandated to that. Like it's set in stone. If the data indicates that they don't need to, then that's fine.
Look at retail sales. They came in way better than expected. Right.
Yeah, and Michigan consumer sentiment came in better than expected. So things are, things are, again, if the economy runs continually super hot over the next 3 months and unemployment continues to move lower and inflation, is still at 4%, then I don't think they should cut rates at all. I agree. I think, again, they have their reason for saying that yesterday, and we'll see if that ends up being true or not. Because obviously, Powell was wrong. He was saying that we were going to see pain in the labor markets a year ago, and never really saw it. I mean, you saw big tech companies laying people off, but you never really saw unemployment increase like Powell thought it would. So who's to say he's not going to be wrong again now? But either way,
I'm just saying, with the 40 plus years of experience, I keep saying this, and I've seen every market you can think of in the 40 years. Okay, is that with what I'm seeing on a technical basis? If anyone's out there, I'm not allowed to give investment advice, but if I was long, I would be laying into this and selling into this very aggressively.
Yep. Well, Steve, any individual stocks you like or dislike right now?
No, I would just basically think about just looking at the ETFs, and no, I would be looking to buy anything here at all.
All right. Well, Steve, always great to have you on Benzinga Live. Always great to get your outlook, see what you're saying. As you said, years of experience. We could probably all learn a thing or two from you.
Thanks, brother. Thanks, man. I'll see you next week, everybody.
Next week. Happy holidays.
Take care. Happy holidays.
All right, guys, that was Steve Kalyjian. If you want to check out more of him, go to tradeeasy.com. Let's keep it ticking. I got my man Rob Roy hanging out. We're gonna bring on some more traders. Mr. Roy, let's see what his perception of this rally is. See, if he thinks it's gonna keep going, if he'd be selling as well, like Steve said. Without further ado, let's give Steve our special intro. Or sorry, Rob. Got the baseball cap today. How you doing, Mr. Rob Roy? Uh-oh, we got you on mute.
Hey, how you doing? Sorry about that.
All good, man. How you doing?
I'm great. How have you been?
Hey, it's hard to complain when the market's at all-time highs, baby.
It's rocking, man. It's rocking. It's a strong move.
So let me pull up your screen. Let me see what we're looking at here.
So we've got a chart of the S&P 500, right? My favorite of all to talk about, right? So we talked a couple of weeks back, month and a half, whatever it was, about this 4181 level, this dark black line down here, which is a Fibonacci level. And if I stretch this back a little bit, make it a little narrow to see, a little bit small, but back here in May of this year, we came and tested it both from the downside and then retested as a support and a bounce. We had a lot of hits on it prior to that. Right, and this level has proved extremely important for, and again, a lot of lines run back here, but extremely important all the way back from 2021, right? Which was really the first time we got into that level there, and that was the catalyst. But I was still not in a bullish mode at that point because we had multiple things happening. We were in a true bearish bias on the S&P, meaning our moving averages were all pointing to bear. As we started moving up, we were in a downward pattern, a downtrend level at one point. And then we finally broke out. That level just was amazing how it held, and we gapped right through there. And that was the catalyst, right? If you didn't have anything that pulled back off of, if you took an early trade here, an aggressive entry, we waited for this pullback into the moving average to get your next bounce, right? And now we're back in an uptrend. We're in phase 3. This was phase 1. Right up in here, this was phase 1 of our uptrend, phase 2, phase 3. And we're back in that uptrend, and I'm hearing it all the time. Where are we going to? Where's the top? Where's it going to run out of steam? What's our next level? What should we be looking for? We've got a lot of fib lines already drawn there, Aaron, but is it okay if I share a technique? You may not understand all the steps behind it or the mechanics of it, but is it okay if I share it to show you where the expectation from Fibonacci are of where we think the market goes to next?
Yeah, and I mean, I guess right now, right, like I was just talking to Steve before this. I mean, at what point do you think we run out of steam versus, the conflicting? It's either right that we're going to run out of steam and have some sort of reversal or stagnate, or the trend is your friend and it's just going to keep going higher. What is going to be your signal that shows us, okay, now we're kind of, not in bullish territory anymore?
Right. So let's take the previous run that we had on the fibs, on the S&P 500. Let's take that run, and we're going to measure that movement. And then from there, we're going to measure how far we've pulled back. So the movement from this low point down here, we'll call that A. It moved up to the high point here, we'll call it B. Right? That's 100% of the move took place in there. There's no disputing that. You could see it. It failed off of that level. From this pullback, we want what's called a measured move off of that level of where the expectation goes next. And we can use Fibonacci tools to help us find that. So if I come over here and click on where I said A, right, we come here and click on B, and C is going to be the lowest low that we pulled back to before we broke. And that happened right beyond that 4181 level. Now I'm going to bring this in a little bit. It's become a little bit easier to see because we don't need all that historical data back there. But basically that measured move from A to B, we want to see where that goes from there. So we've got 3 lines that basically got dropped in. This 0.236 line, this green line that's right in here. We have a 0.618 line, this purple line, and then one more line above, which is this other green line right here, green or blackish line right there. So what we're looking at there, Aaron, is when we pushed up to this 236 and got into this level, there's, I don't want to call it confirmation, but that becomes a hesitation point in many cases, and it did not. it broke right through that, which was giving us bullish signals. By the way, it did not slow down there. It broke right through. Okay, it broke out up here, and our next target that we've been looking for is that 45.9707 level, 4,600. We're right in that same range, and we bumped our heads on it. We came up close here. We came back here, here, and this before we finally broke out. 4 or 5 times we attempted at that before we broke. So that level became extremely important to us. So that level says from that initial move of 100% down to the pullback point C, if that whole move was $10 to pick a number, it pulled back to this level point C here. And now we're looking for another $10 move off of C. And this shows us that we've gone about 61.8% of that move has been achieved already up to this purple line. Does that make sense so far, Aaron?
Yeah, so far it does make sense.
Good. All right. So now if we scrunch this down a little bit, there's another line up here at 49.01. I don't even have my 100-point levels drawn that high yet because we haven't got that. These dot dash lines on the S&P, I always use 100-point levels as potential targets. So we're looking at that 49.02-ish level as a topping pattern, a place that we're going to run out of steam, right? So I don't foresee it going any further than that, at least not up front. I think we're going to see a decent pullback from there before we get a continuation press out of it. Now, that bar's news, right? The Fed comes out and says, you know what, everything we talked about the other day is all true. Plus, we're going to start cutting rates now. We're not as dovish any longer. We don't think that we're going to see only a 4.6% rate come the end of next year of 2024. We think it's going to be 3.9%, right? All of those things could cause a catalyst for us to move further. But all things remaining equal, that 4,900 is the topping level of where we see it going to next.
Got it. And then right now on any of your, individual names that you trade, making any significant moves that you either like or dislike, or how are you kind of playing those?
So I've got a couple of them right now. Let me just back this out a little bit. Right. So AMD is the very first one, right? Lower price stock. We had a nice breakout. As much as I would love to see this pull back to that 131 level down by this fib line, I don't know if it's going to happen. And keep in mind, we're traders, not investors. So we're not holding long term. We're in, we're out, a couple of hours, a couple of minutes, a couple of days. That's all it is. If we get the bounce off that 137.56, we're looking at 144.25 as our target. If we break, I'm going to wait for it to come back to that 131 level and bounce off of there. That would give me a much cleaner signal on AMD. So that's first one.
I like that. I mean, AMD has been outperforming NVIDIA now the past couple weeks, which I think, when you have a company like NVIDIA, which has been up so much this year and obviously been kind of the darling of the tech sector and with ChatGPT and all this AI stuff. But eventually, I feel like you always kind of see this reversion to the mean where a direct competitor like AMD will catch up at some point, kind of, at least, in the sense that over the last at least 2 weeks, AMD has way outperformed NVIDIA to where, I always like looking at the competitor of kind of like similarly, everyone, Microsoft has been with OpenAI as well, doing really well. And I'm like, what about Google? Like Google was struggling a couple of months ago, and I was buying some Google shares, and that's kind of been doing well as well.
Right. So Google is actually the next one on my list.
Oh, there we go. Perfect.
But they're down a little bit now. See, we've got to look at pattern, right? We had a high, we had a lower high, and now we've put in another lower high. The issue there, though, is we are not setting up a bearish wedge here or bearish descending triangle. If we come off of these tops, you can see the lower tops there, but we have higher lows. So we actually have a wedge pattern. And again, we can use things like Fibonacci to tell us where the breakout needs to take place. And if it doesn't take place there, the expectation becomes very small that the breakout is going to be of any significance at all. So if we look, make sure I've got it on this screen here. Yeah, okay. So if we look at this right here, we're looking at a breakout to take place. It's already happened from a few days ago up until the 21st, which I guess is tomorrow. No, next Thursday, right? A week from today. Somewhere in between there, we're looking for the breakout. If we can get the breakout in that range, then we have the opportunity for a decent move. About 40% up or down would be the move expectation if we get it. If it goes beyond that, Aaron, that's when you get into that cone or that wedge, that point of those two lines, that convex, and you just kind of tend to peter out most times. Then you don't get strong directional moves. So we could take the direction either way here, right? It's setting up bearish as of today just because of that $1.30 move to the downside today. But overall, I'm still a fan of Google. I'm still long on Google.
Yeah, I mean, and I think long term with Google, it's like, you know, are they the leader right now in AI? No, probably not. That's probably OpenAI and Microsoft. But will Google be, you know, have an AI component and also benefit from it long term? Of course, it's Google. It's too big of a company, you know, not to. So there was actually that huge dip earlier this year on Google when it released its AI thing, and people thought, oh my God, this thing is terrible. It's not as good as, and I think, you know, Google lost like over $10 billion in market cap in a single day. And I took it as a buying opportunity, and you know, it's treated me well over the last few months. But like you said, we got to watch these patterns. To me, Rob, I mean, that chart doesn't look great, at least in the short term. But you know, again, Google, I think, will be fine in the long term.
I agree. And then we get a little more volatility in MasterCard. I love the credit card space. People use them like crazy right now. One of the highest credit card debts we've ever seen in this country. I like that it failed at this 136 level. On a Fibonacci, from Fibonacci speak, that negative 136 is a hesitation level. So we're not saying it's not going to break out of there, but we expect it to hesitate when a position gets there. 2 days, we failed off it today. If we can get the pullback to that 416.25 level and a bounce, we've got a confluence of our moving average. We're looking at 424 as our next target up again. So if you miss the last run, you've got an opportunity, if we get that pullback, to take another bite at the apple.
Yeah, I actually hold some MasterCard and Visa as well. I love these stocks. I think they're great. I will say real quick, Rob, on the point, and I know you're not doing this, but just because you brought up the fact that national credit card debt reaching all-time highs or whatever, I just want to make this point because I see that a lot from people that are kind of, you know, more bearish, or they're perma bears, or they want to make it seem like, you know, the zero hedges of the world that want to make it seem like, oh my God, the sky's falling, everything's really bad. One thing about the credit card reaching national or record limits is okay. If you take into account, say credit card debt makes up 5% of the GDP. As GDP grows, so is the credit card debt. So because the economy is basically at, like, you know, all-time high, whatever, it kind of makes sense then if you have the same proportion of credit card debt that you always had, that over time it'll increase as people are spending more and more money, as inflation happens, as more and more people enter the economy and start spending money. So that fact alone, that you know, national credit card debts reaching all-time highs, isn't necessarily a bad thing. And in fact, a lot of economists argue it's a good thing. It's showing people are spending money. Now, the caveat to that is if you see the increase and it's way out of proportion, if it's usually 5% of the GDP or whatever, then all of a sudden it shoots up to 10%, then okay, obviously that could be a problem if people really just can't afford things and they're putting more and more on their credit card. But I don't think right now that's really the case. So just something to consider, because I know a lot of people will try to use that stat as a reason to be super bearish or to think the economy is worse than it is.
Absolutely. And you're spot on with all of it, in my opinion. And that's why I said it, you know, all-time high credit card debt. That's a good thing for the credit card company. They're making 3% on every dollar that people keep on that credit card. Boom. And they hold.
And if you thought, you know, this credit card thing was going to be a huge problem and create like a crash, then you probably wouldn't want to be buying these companies anyway, even if you knew they're good for the company, because obviously a crash and recession or whatever, even if, you know, wouldn't be great for Visa and MasterCard as people see a slowdown in spending. So again, just wanted to bring that point up. So I'll let you get on with it. We got time for a few more.
Good. Netflix. Right. I love Netflix. One of my top 3 trading companies every day is Netflix. It's Netflix.
New 52-week highs yesterday on Netflix.
Yeah, it's just it's amazing the moves that it's made, right? So we've got a really nice pattern here. We had this run up, a good pullback. 236 is a hesitation point. We got a great bounce. We got the fail today, right? That it was hard to capture that move the previous day, right, from yesterday. So if we can get the pullback and get near that 466 half level, close near there, come back to it and bounce tomorrow, come back up. You got 483, 42.75 is our upside target. There's a lot of opportunity on this. You know, the biggest thing traders miss, if you look at Netflix, you go, oh, if I got to buy shares, you know, at $470, it's a lot of money, 47 grand just to buy 100 shares. But you can buy options on this for $10 for this week, of course. So if you're looking to get in and out of this trade today, tomorrow, you can get in for a very low cost and not have a lot at risk in the trade, but the upside potential is massive if you're right on this trade.
Yeah, and again, Netflix new 52-week highs yesterday, had some bullish news going. In the headlines the last couple weeks that they're getting more into live sports, which I think is a no-brainer for the company. I've been saying they should do that for years and years and years. And so yeah, I mean, if you like Netflix, I don't know, maybe I'd be a little bit cautious about buying it up here just because it's already ran so much. But I mean, if you like it long term, then why not start building a small position while you have some positive sentiment around it.
Yeah, in this market, I don't think it's wise to do anything buying long if you're not doing it off of some form of pullback. If you on this run, if we were up over here somewhere without any real pullback and you're trying to enter, yeah, it worked out great. It's not my style of trade. I think there's too much risk because that stair step pattern, the move up, small pullback, move up, small pullback, is what gives us the best opportunity of knowing, all right, the bulls were running it, the bears took it back a little bit, we rested, and now we're going to run again. Right? Instead of just this fast run where you're trying to make it all the way to the top in one shot without any rest, excuse me, it just lends itself to more risk. At least from my style of trading, it doesn't work.
Well, just speaking of fast move, I mean, since you've been on, Rob, the S&P has moved higher again. We're now back, almost to 473 here on the SPY. So nice little rally since you've came on, Rob. You might be the good luck charm for the SPY, but I'll go ahead and kick it back to your screen, and you can take us to the next one after Netflix.
NVIDIA, I get, the AMD is beating them right now, but I'm still a huge NVIDIA fan. I like that they finally bounced from where they were. Good pullback. We bounced. We've moved into what I call a true bullish bias based on our moving averages. And now we're sitting at that 480 level. If we can close near here and bounce, you've got room up to 494. Same scenario. On a Friday, if you're taking this trade on an NVIDIA, you're looking at $10, $12, maybe $8 for the option. I mean, VIX is coming down. We'll see what it is this week as far as costs, but they've been very low cost lately because of how low our VIX is. So there's a lot of opportunity on an NVIDIA. And again, I'm only talking from trader, not investor. I'm not buying any of these long-term. Whatever I have long-term, I have. I'm renting those stocks out. Right now, I'm not adding anything new to the portfolio. Everything is trade, not invest.
There you go. So you would be, sorry, recap that trade for me one more time. You'd be buying calls on NVIDIA?
Yep. So if we can close about where we are, retest and bounce tomorrow, I'm going to buy a call option. The nice
that
thing
expires tomorrow?
For tomorrow. Yep.
I like that. Let me know, email me what you do tomorrow, Rob, because I'd love to take some, same day expiration calls on NVIDIA, something like that, just to have some action tomorrow. I think I'd like that.
Yeah. We have a service that we actually do with the SPX that we email out daily for same day expiration. It's a great tool. We're actually working with a new broker right now, brokerage firm to utilize them. If they can get their pricing where they say they can, they'll be the lowest in the industry and a really good options broker. But they'll be the lowest in the industry for the same day expiration on SPX. It's just a huge part of that fee is the CBOE. So, but you got it.
All right, cool. All right, Rob, give us one more.
That's it. W day is the last one. We had a nice run up, a pullback, and a breakout of the zero line, and now we retested. Same scenario. If we can get a bounce off of that 273 half level, we're looking at 283. $10 move. You'll pay about $6 for this option tomorrow. Life is good. I mean, $6 for the option with a 70 delta. If you can get a $5 move, so $5 times 7, that's about $3.50 move on your option price. Not horrible to make $350 on a $500, $600 investment.
Yeah, not bad at all. Well, Rob, always great to get your insights on Benzinga Live. Always great to hear about what you're trading. If people want more from you, where should they go?
Tradinglikeaboss.com would be the best place to get in touch, guys. There's tons of resources. Particularly, there's one called Trade with Rob, where we send free trade ideas out a couple of times a week with the explanation of what we're looking to do. So take advantage of it. It's all free. Everything on this page actually is free.
There you go. Nothing better than free. Rob, enjoy the rest of your Thursday and week. I will we'll chat next week.
You got it. All right, Aaron. Take care. Have a good one. Take care, everybody.
You do the same. All right, guys. Tradinglikeaboss.com if you want more from Rob Roy. Always he does some really great trades when it comes to like spreads and stuff. That's a little bit above my head, but I mean, one of the better dudes in the industry because I mean, face it, like a lot of these guys go to their site, this course, that course, here's how much you got to spend. Like he said, all the stuff on there is free. No reason not to check it out. Elon, what up, Elon? How we doing? Asking about ARM. So here's the thing, in my opinion, with these types of stocks right now. ARM's revenue right now is like here, let's go to the financials. Let's go to the income statement. ARM's revenue right now is like less than $3 billion a year. This is a recently IPO in the semiconductor space. ARM's revenue is less than $3 billion a year, currently trading at about $70 billion market cap. So that means you would need to hold, your ARM, basically if it didn't grow for 25 years. I don't think it's super expensive, but I also think at some point, there's not really going to be a lot of catalysts to keep this thing moving higher until you start seeing that growth translated into numbers, translated into, quarter over quarter growth, year over year growth. And until we start seeing that, I'd be worried about this stock running out of some steam just because looking at how much it's been up recently. I mean, you're looking at this thing went from 63 to 71 just in a few days, of course, with everything else. Now, the flip side to that is if we're talking about more rate cuts and whatnot, then obviously that's great for a growth company like this, like ARM, and that could get investors excited now, even knowing that there's not going to be a lot of good catalysts coming in the near term, but in the future, you might start seeing some of that growth. Stock now finally back to its IPO price. You can see this chart, actually a pretty good looking chart. So it all depends on your time frame. If you were looking at this as a swing trade over the next month, over the next 2 months, I'd be a little bit cautious right now, just looking at this run. Again, we're looking at, from November 1st, from 50 to 71, pretty hefty run there. But if you wanted to start building a position on this long term, I mean, look, again, the revenue right now is around $3 billion. That could easily be $5 billion in 2 years. And then that could be $10 billion. And next thing you know, you're looking at an $150 billion market cap company instead of a $70 billion. So I don't hate starting to build a position here. I would just be scared about buying this to say hold for the next couple of weeks because I could easily see it dropping back down here to $60 or something. And so, if it were me and I loved ARM long term, what I would start doing is I'd buy a few shares, maybe, here in the next couple days. I'd wait. If it drops down to around 60, I'd buy some more. And if it doesn't, then I'd, keep adding. I don't think it's any, if it keeps going up, then it shows you that the market's not worried about its valuation right now. And it doesn't think it's too expensive. So the market will tell you if it's too expensive. I'm a big, oh, you bought at 50, probably okay to hold. Yeah, and again, I would say it depends on your outlook. If this was a swing trade for you and you're up 30% on it from 50 to 70, or you're up 40% on it, then yeah, maybe start trimming. If you love this long term, then hold. That's like our biggest lesson. And I talked about this on Tuesday with Ryan Pinnell and what Warren Buffett and Ray Dalio and these guys are able to do is they get more out of their winners than they do lose on their losers because they let their winners run or they double down on their winners. Look at what Buffett's done with Apple. Buffett's made more money off Apple than any other stock in his whole entire life. And well, I guess as long as you don't count Berkshire Hathaway, because I mean, of course, they were buying a textile company worth like a few $1 million and have now made it into a multi $billion thing. So, but Buffett's made more money on Apple than any other stock. And he's not like, oh, I'm gonna, sell this Apple because I made so much on it. He keeps buying more. Well, actually, I don't know. I don't know when the last time Buffett bought Apple, but he was buying more as it was going up throughout the last I don't know he bought Apple until 2016, but over the last 8 years, he's added to his Apple position a lot. Whereas a lot of traders would say, oh, hey, I'm up 80% on this. I'm going to go sell it and find another trade opportunity. Why? You already found a great one. Why not just keep adding to it? Which I'm not saying that specifically for ARM because I have not looked into this, Elon. I'm not saying just keep adding to ARM, but I'm saying if you love it long term, and you are happy with your position and you follow the company and you're happy with all the moves the company's making, you have no reason to sell it. And in fact, would probably be better off buying it. I also own Yeti stock. I haven't checked this one in a while. Wow. Holy shit. Glad I own this one. I don't know. It seems like the Stanley Cups have become the new hottest thing on TikTok and other social media things. So I'd be a little bit worried about that the Stanley brand is going to end up taking a little bit of Yeti's market share. That'd be my only concern right now. Otherwise, it seems like a great consumer brand. Seems like people love them. All right, guys. Gonna go ahead and start wrapping up for the day. We'll be back later this afternoon on some swing trading and some other great content tomorrow. We'll be back live on pre-market prep 8 a.m. and then live trading followed by that. Make sure to stay tuned. Thanks to everyone who tuned in today. Keep interesting markets like Steve and Rob have different views on the outlook. Yeah, it's always good to get people with different viewpoints on. I mean, I don't know. I don't know what I would say. I mean, I think I'm long-term bullish like I always am, but I think, in the short term here, we could see a little bit of a pullback, a little bit of stagnation potentially. Thank you, Elon. Thank you to everyone who tuned in. Can't short Foot Locker anymore. I've got some more stocks I want to talk about, so I'm going to hop on live trading tomorrow. But till then, peace and love. Please smash the like, sub to the channel if you haven't already. Follow me on Twitter. It's up there. Peace.